Greg is a partner with Fasken Martin and Mullen LLP. He is the chairman of the firm's private equity group and an active member of several other practice groups, including Securities, Mergers and Acquisitions, and the Asia Pacific Practice Group. Greg carries on an active transaction-oriented practice with a special focus on advising high-growth and mid-market companies with a global outlook, as well as several Canadian investment dealers, merchant banks, and private equity funds that provide financing to them. His expertise is in the areas of mergers and acquisitions, venture capital, and private equity investment and corporate finance in both the public and private market contexts. He represents both issuers and agents, underwriters active in Canadian financial markets. Greg is actively engaged in Fasken's international business development initiatives as well, and is co-leader of the firm's Indian team and a member of the firm's China team. Two biggies here. He has participated in several business and economic development missions to both India and China. Greg has extensive experience in serving on the board of directors of private and public companies and a variety of not-for-profit organizations. He is currently a director of Invest Toronto Corporation in Thai Toronto and a member of Canada-China Business Council. Greg has had leadership roles with both domestic and international not-for-profit organizations, including Outward Bound Canada, Street Kids International, Families for Children, and Amani Children Home. Please help me welcome this distinguished speaker that we have today. Before Craig takes the mic, since it's a new format that we are having today, Craig with Nancy Eastman is going to take this 2/3 of the session today together, and it will continue after dinner break as well. Nancy Eastman is a partner in the firm's business law group. Nancy practices security law with a focus on domestic and cross-border corporate finance, mergers and acquisitions, regulatory compliance, and corporate governance. Nancy has worked on a variety of security matters, including debt and equity financing for private and public companies, initial public offerings, reverse takeovers, capital pool companies, and qualifying transactions, stock exchange listings, plans of arrangement, applications to regulatory authorities, and shareholders meetings. She acts for a number of Toronto Stock Exchange and TSX Venture Exchange listed companies, and regularly advises them on continuous disclosure requirements and compliance with exchange policies. Please help me welcome this talented lady that Craig has brought on board today to speak to you.
We're going to sit down because I'm too old to stand up for an hour, so I hope you'll indulge us. And if you can't see me, it doesn't matter, but if you can't see Nancy, then I would suggest you move up a little bit. First of all, I wanted to thank Nancy from the bottom of my heart for stepping in. One of our other colleagues, Paul Brasic, was going to help me with this presentation this evening, as was one of my intellectual property colleagues. The latter, his baby arrived just 2 days ago, 6 weeks early, and Paul had an emergency family crisis today, so I lost them both. And Nancy, being the outstanding partner she has, very kindly stepped in. And I think things happen for a reason. I mean, Nancy is an outstanding corporate lawyer, and I've been really privileged to have her as my partner for about 10 years. So I'm really glad Nancy could be here. So thank you, Nancy, for doing that. We're going to split the presentation up a little bit and to about 4 sections. And so we're going to be going back and forth. Every now and Nancy will jump in from time to time. 1, to correct me when I'm wrong. 2, to provide anecdotal information. Because I think for you entrepreneurs, it's probably, I think the things that can be as helpful as learning the general principles that we're going to talk to you a little bit about today when making a decision about the right type of business organization to choose when you're launching your new enterprise, and talk to you a little bit about the evolution of your enterprise, how it can start as one thing and very naturally and strategically evolve into another, from a sole proprietorship to a partnership to a corporation. We'll take you through all that, but we both have lots of stories, seen lots of clients do all sorts of great things and also make all sorts of fundamental mistakes. And I think sometimes those little war stories can be very instructive. So we will be interrupting each other as graciously as possible just to share some of that. So Nancy's going to take it off the top. She's going to take you through the three principal forms of business organization. There is one a subset of partnerships, limited partnerships, that I might talk a little bit about as well, because I had a lot of my practice focused around them for many years. So I think now I'll just turn it over to Nancy and we'll get started. Thank you.
Okay, thanks so much, Craig. So first, starting on the first slide, I think you can all see that the three sort of principal business organizations that there are sole proprietorship, partnership, and a corporation. You may be familiar with some of these on a basic level, but there are some differences that you may not be aware of for some of them. First of all, deciding which type of business organization to use will be fact specific. It's not like you can go to anyone and ask them if the corporation's better or partnership's better, but it's going to depend on your fact situation, whether it's from a liability point of view or a tax point of view. You're going to have to assess your own situation. And obviously some businesses may evolve from a sole proprietorship into a partnership and then to a corporation as they become larger. The simplest form is obviously the sole proprietorship. It's basically when you have one owner of the business. This may be simply somebody going out and starting their own landscaping business. They'll be the owner, they'll be the person who owns all of the assets. They will be entitled to all the profits. They will also be personally responsible for all the debts. And because it's a sole proprietorship, it's not a separate legal entity, so that person really is the business. They're responsible for all the liabilities and the debts that the business incurs, which means that their personal assets may be on the hook if there are liabilities and debts of the corporation. That's one point you need to remember about a sole proprietorship. The other aspect about sole proprietorships is that the income is reported on your personal income tax. So if you have losses, that's, well, not good from a business point of view, but it helps offset other income that you may have from other sources. So that's sort of one example or one advantage of the sole proprietorship. Again, just to formally go through some of the advantages. Setting up a sole proprietorship is basically very easy and inexpensive. It may be as simple as taking your lemonade stand to the curb and selling lemonade, and all of a sudden you're a sole proprietor. Whether you want to register a business name, if you do business under a name other than your own, you simply file a one-page document with the government offices to register that business name. What typically you have to do before you register that name is you have to do a name search. So once you choose a name for your business, you search it to see if there are other businesses that have a similar name. So if there's an exact business name out there, then you don't want to get sued by anybody for using their name or get into trouble. So you make sure you have a clear name first. There's few regulatory burdens associated with a sole proprietorship, unlike corporations and partnerships. Startup costs, again, can be deducted by the sole proprietor. Again, the decision making is yours. You're the owner of the business. You get to make all the decisions. And it's also simple to dissolve. You're the only owner. You own all the assets. If you want to stop doing business, you just simply stop doing business. You can sell the assets off.
I think it's just a good point, a good time to point out that I think so often you see an entrepreneur come up with an idea, and the first thing he's spending time on is building a brand around his idea. And he wants to memorialize that brand in a corporate name. And he wants to have a corporation, he wants to file articles of incorporation. What he doesn't realize is that he's really opening a bit of a Pandora's box as far as expenses go. There are advantages to a corporation that we're going to get to in a moment, but so often there are many months, sometimes the first year or two, before you have any positive cash flow, and you really want to be able to enjoy all those expenses and not have them locked up in a corporate entity up above. So if you're starting a business while you're maintaining a job as an employee somewhere else, you can use some of those losses to offset other income. So there are great advantages to maintaining it as a sole proprietorship before you evolve it into a more sophisticated entity.
So although there are advantages, there are also disadvantages to sole proprietorship. Basically, you have some limited ability to raise capital. It's your business, so it's basically you and your contacts or your ability to raise or borrow money from the banks. There may be a lack of credibility. I mean, if you start a business up and you're the only owner, what happens if you die? What happens to the business? People may be hesitant to get in business with you if they don't see how the company will continue beyond you. You can transfer ownership only by a sale of assets. So if you build up a substantial business as a sole proprietor and you have lots of assets like equipment and inventory, accounts receivable, vehicles, if you decide to sell the business, the actual transaction gets a little bit complicated because you have to make sure that you're transferring each asset individually or as a group of assets. So it adds to the documentation and the legal work that has to be prepared to actually transfer all those assets. As opposed to if you own a corporation and it's all packaged up in a corporation and you can sell shares, which we can talk about a bit later. One of the biggest disadvantages of sole proprietorship is there's unlimited liability. You're basically on the hook for all the debts and liabilities. And again, as I mentioned previously, your personal assets could be attacked by creditors if you have business debts or liabilities. So you may own a house or other personal assets, and you may want to think twice about starting up a sole proprietorship if you're worried about losing your personal assets in your house or so forth.
And that's really relevant when you are coming up with a new technology or a new product. If there's any torts that could arise around product liability, if you have a corporation, that product liability can usually land at the corporate level, and then only the actual assets of the corporation are liable. But in your personal capacity, as Nancy said, all of your assets are vulnerable. And if you do have a sole proprietorship and it is becoming significant, it may be worth doing some creative creditor proofing by putting certain assets in the name of your spouse, a trust, and there's other asset or creditor protection mechanisms that can be measures that can be taken while you are a sole proprietorship if it is becoming significant and you want to do that before you move it or roll it into a corporation.
So you're moving on from a sole proprietorship. You decide it's time to take on a partner. How do you do that? Well, a partnership may be created without you even realizing it. The definition in the Partnerships Act states that a partnership is a relationship that subsists between two or more persons carrying on business in common with a view to a profit. So if you suddenly find yourself in business with another person and you're both carrying on business in common and you're trying to make a profit, it may be construed as a partnership whether you realize it or not. That's an important thing to realize if once you start going into business with other people, that you definitely have to think about. Why some people might use partnerships. Typically, you form them to exploit the collective skills, talents, and assets of two or more people. Two heads are always better than one, they say. This way, it expands your ability to reach out to networks and raise capital. Also spreads out the liability a bit as well. And some sole proprietors just naturally grow larger, and it makes more sense for them to become partnerships.
Yeah, and obviously, you can grow your business below you by bringing in employees. Sole proprietors and partnerships can have employees. But there is obviously a difference, I think, often in the ethic of that person, if they're a stakeholder or not. And I think often to ensure that you've really got their commitment, that they're as committed to the growth and success of the enterprise as you are, that giving them that ownership stake, bringing them on as a partner is often really quite critical to creating the dynamic that you really want with your partner and the sort of growth that you want to achieve. But it's important to recognize that an agency relationship is essentially created. If Suresh and I go into partnership together, he has the ability to bind the partnership, but we have joint and several liability. So he can go out and make a commitment that I didn't know about, but the world knows that we're partners. They can rely on his ability to bind the partnership. So I've got to be very comfortable, as I am, in Suresh's good judgment, that he's not going to make commitments that are not in the best interest of our business. So the selection of a partner can never, ever be taken lightly.
Yeah, again, as I spoke about, partnerships can be formed inadvertently, so just be careful about that and how third parties, other people perceive you and the people that you may be doing business with, whether or not you have a formal partnership or not. You probably heard the terms joint venture, co-tenancy, co-ownership. They're different from a partnership, and there are some important differences. When you have a partnership and you want to sell your partnership interest, you need to get consent from all the other partners. So your interest is not freely alienable. Also, when there's a partnership, you have each partner is an agent of the partnership. And so as Craig was talking about, each partner can bind the other one, which is important when it comes down to the liabilities. As Craig mentioned, you're jointly and severally liable for your partners, for any liabilities of the partnership. So if your partners are doing things that you're not aware of, you may be on the hook for that. Not to totally scare you away about your evil partners, at common law there is a duty of good faith imposed on all partners. So basically, partners are required to act in the best interest of the partnership, and you can't actively do any activity that might conflict with the business of the partnership. So you do have a little bit of protection there. Yeah, again, we're just talking here about all partners are jointly and severally responsible for the liabilities up to the total value of the personal assets. Now, the partnerships are generally, there's a Partnership Act which sets out some of the rules for partnership to follow, but there's also a lot of common law that governs the law on partnerships. And a lot of that can also be governed by a partnership agreement. So if you want to set out a partnership agreement, you can lay out the terms of the partnership, set out what each person's rights and responsibilities will be, what your obligations are, and go beyond what's found in the Act and common law. You can have a simple form of partnership agreement, simply setting out the basics, it could be 5 pages long, or you could get into a very detailed document, 50, 100 pages, depending on the business and I guess the level of things you want to agree upon ahead of time. A lot of times when people are starting out with business with other people, they're only thinking about the positive things and the great things that the business is going to do, and then it's the lawyer's job to tell them, well, what happens when you both decide you want to go different paths, or what happens when you both have disagreement and when things go wrong? And then that's when they start to say, oh, I never thought of that. So it's our job to sort of build in some provisions and agreements so that they can think about how things will be resolved in the future when they come to those problems.
And I think it's really important to point out that the Partnership Act in Ontario, and I think most of the similar legislation, again, it's a provincial statute, most of the analogous statutes in other provinces are very similar. They provide a number of things that you can contract out. For example, the Partnership Act says that all partners are entitled to share in the profits equally. But if you can contract out of that with an express agreement to the contrary that says Suresh and Nancy are partners, but Nancy's doing most of the work, so we want her to have 50% of the profits, and Suresh and I'll split 25-25. You can make those sort of distinctions. You can't do that so much about liability, although you can create indemnity arrangements within the partnership agreement. But what's in the partnership agreement is really limited only to the imagination of the partners. You can put in as many checks and balances as you want. And I would say that before you sit down and draft a partnership agreement or have your counsel do it, you understand what's in the Partnership Act and understand that's what I'm going to be stuck with until I get that partnership agreement. So if you want terms that are any way different than what the statute provides, it's critical that you get a partnership agreement. And that's why you need to have counsel to help you put that together.
So again, we'll just go through some of the advantages of a partnership. It's quick and relatively inexpensive to establish, especially when we compare it to establishing a corporation, which I'll talk about in a few moments. Again, like a sole proprietorship, you register a name of the partnership, and you may or may not have a partnership agreement to govern that relationship. For tax purposes, a partnership prepares and reports the tax reporting from the partnership, but the net losses or the net income are reported on the partner's income taxes. Again, another advantage is you're pooling talent and network and capital financial abilities and credit abilities of all the partners. There's increased access to credit. The ownership interest can also be sold with consent of the partner. So it's easier to sell your ownership interest in a partnership than if you're the sole proprietor, again, and you're trying to sell your business. It's a little bit easier to actually sell your interest in the ownership, in the partnership.
Yeah. And so, but just to be clear on that tax point, so a partnership is just a conduit. Income, or whether it's income or losses, whatever happens at the partnership, simply preserves its character and flows down proportionally to the partners. So if you have net income at the end of the year, the partnership itself is not a taxable entity. That income will then go down and be taxed in the hands of the partners. So it's just important that, like a trust, a partnership is just a conduit for tax purposes.
And the disadvantages to a partnership. Well, you may have 3 partners and they're all equal. So we don't have any hierarchy here for anyone to take the lead or to break a tie when you have disagreements. So that can lead to tensions among your partners. The liability of partners is joint and several. That means, again, that you're liable for any debts or liabilities that your partners may incur through the partnership. Liquidity is limited or requires the consent of the other partners. Dissolution may be complicated and contentious. It's a little bit more difficult to break a partnership than obviously a sole proprietorship. And unless the partnership provides otherwise, if one of the partners dies, then that will dissolve the partnership. So that's another important term that you need to think ahead if you're preparing your partnership agreements, that obviously you're not thinking about at the time. Then there's a special type of partnerships, which is called a limited partnership. These require a little bit more care when you're trying to create one, because the legal requirements are a little different than a partnership. When you create, it's created when there's a declaration signed by general partners, and it has to be filed with the government office. Generally, there has to be one or more general partners to form a limited partnership, and the general partner is the entity that has the unlimited liability, whereas the limited partners will have liability that will be limited to whatever their contribution was to the partnership. So this is the type of partnership you can use if you want to limit your liability and not have to worry about that unlimited liability. But you do have to have a general partner with that unlimited liability. Although you can set up a corporation as a general partnership to add another layer to get around that a little bit. And as a limited partner, you're generally not involved in control or management of the business, but you can provide advice or be an agent of the partnership.
And in fact, there's a lot of case out there now where limited partners have been concerned about the management capabilities of the general partner, have exerted some authority, tried to become involved, and by virtue of doing that, they end up becoming deemed to be a general partner and then are therefore generally liable. So it's very important if you ever go into, you'll see these are very common investment vehicles. For example, all the private equity funds are structured as limited partnerships where the private equity sponsor, the talented management team has a corporation that acts as the GP, and they make all the investment decisions, and the limited partners are absolutely passive. Usually, except for a few critical decisions that are, and decisions around those very, very few and very unique events are memorialized in the limited partnership agreement, but it's imperative that limited partners remain passive and not involved in management, or they can lose the protection of limited liability.
Another term you probably heard we mentioned earlier is the joint ventures. This is not a type, this is not really a way of organizing your business, but this is a term you probably heard, so we thought we would talk about it a little bit. A joint venture is generally when you have 2 separate businesses that are coming together for a single purpose or a specific project. It's basically, a joint venture is when there's a collaborative project or arrangement involving the combined resources of 2 or more parties in pursuit of certain business objectives, often combined to a single project of limited duration. I come across a lot of joint ventures in the mining industry. I do a lot of work for mining companies. And so one of the examples, I think, for a classic joint venture is when two mines come together for a single property that they would like to do exploration on or develop. And you know, they don't want to become the agent of each other. They don't want to form a partnership. They want to stay as separate businesses, but just sort of come together to work on this one project. So they had to be very careful about their joint venture agreement to make sure that it's not construed as a partnership.
And those are really common in the mining business. What about the perspective of the third party who's out there dealing with the joint venture? What sort of notice do they have so that they aren't relying on maybe the benefit of, you know, you being a partnership and them being able to look to either one of you for companies that one might make? Is it incumbent on the joint ventures to make sure third parties understand the nature of the relationship to avoid that risk?
Well, it's usually set out pretty clearly in the joint venture agreement. Again, the slide sort of talks about the different ways a joint venture can be formed, and one of the ways is if you have a contractual arrangement. So it's basically just an agreement that you have set up, and there's usually provisions in the agreement that say, you know, clearly you're not an agent, you can't hold yourself out to third parties that, you know, as an agent or that we're a partnership. You may have your joint venture agreement registered on title, so if it is a mining property, you know, there should be notice to the public that there is a joint venture agreement that sort of operates.
Is that a common way to affect notice to the world, is by putting it on title?
Yeah, I think you can do that, because generally, sometimes the joint venture agreements will show the ownership split as well, so you'll want to register the ownership split on interest.
So what are the advantages of joint venture versus partnership?
Well, I think they're different. Like I think like a partnership is really used, I think, when you have like one business in common that you're going to continue with. Whereas a joint venture, you really just do for sort of one-off projects. So I think whether there's an advantage or disadvantage, it just depends on the type of deal you want to go into. Joint venture might be better if you just, you know, we talked about like pick your partners well, like trust your partners. If you don't trust your partners, do a joint venture so you're kept as separate as possible.
So unlike a partnership where if you and I are partners and I die, the partnership ends, in a JV, if say a corporation it becomes insolvent and is dissolved and they're a joint venture partner, does their interest devolve to you, or does it just go to the successors and the creditors of that company?
Yeah, I think it depends on how you set it up, because if you set it up as a joint venture corporation, you may set up an actual corporation to own that property, and you'll have the two joint venture parties as shareholders, so 50 and 80% shareholders in that corporation. So yeah, so if it was simple, it would be you just hold shares in that corporation, so however those shares would be dealt with. Otherwise, it would be set out in the contractual agreement. What, you know, if something happened and one company went bankrupt, you may have a provision where the other company has a right to buy.
The interest. Right.
Yeah, sorry, there's a question?
Are we taking questions?
Oh, sorry. Yeah.
A quick question. Under those circumstances, wouldn't it have been easier just to form a corporation in which each partner owns a certain percentage of that new corporation, which is then the operator, and then that corporation then is a separate entity and can be dealt with much more cleanly from a legal and liability standpoint? Yeah,
I mean, there's different reasons for doing different types of JVs. Sometimes it's tax driven as well. There may be reasons why people want to set a corporation or a partnership. So, whereas like it's cleaner from a legal point of view and ownership, I think there may be other reasons why they might want to use a different way to do it.
There's one more question.
I have a question. How many partners can be involved in GV?
I don't think there's any limit to how many partners. If you've set up a corporate, you could set up a corporation and have as many shareholders as you want really.
I heard a lot about GV, and most of all this is in real estate or development, something like this. So can you tell me what is the difference between partnership and GV in tax and liability purpose?
Tax and liability? Okay. So in a JV, it would be I think, again, it would be a little bit, depends. If you have given notice to the world, for example, in Nancy's discussion where if you had two joint venture partners come together and they have a contractual arrangement that Nancy and I, two joint venture partners, are going to own this mining concession and develop it. That's registered on title. I think that's probably adequate notice to the world that it's a joint venture, not a partnership. So there wouldn't be the risk of there wouldn't be necessarily an agency by law. So I couldn't necessarily bind Nancy and vice versa. And any claims against Nancy wouldn't be my joint and several liability. In a partnership, you would be. So that's an important one from a liability perspective. From a tax perspective, a JV, again, is not a separate legal entity, so it's just whatever income is attributed to you under the agreement, that income is your tax issue, and you might have different offsetting expenses against it, that are quite different than your JV partner. So again, it's not a taxable entity, and that the allocation of both income and losses between the two of you would be contractual, and then you would both file your income tax returns in a manner consistent with what you agreed to.
Thank you.
Okay, we're getting to the final business organization that you're probably most familiar with, which is a corporation.
Right.
So a corporation, just the one clear aspect of a corporation is that it is a separate legal entity. It's created under statute. A corporation has the rights, powers, and privileges of a natural person. So really a corporation, when they say it's like a separate legal entity, that means that unlike the sole proprietorship where you're running a business and that person owns all the assets and everything goes through their personal taxes, a corporate entity is separate. It's like think of it as a person themselves. It files its own tax returns. It can own assets. It can carry on business. So it's very different from a sole proprietorship in that respect. It's also distinct from who owns it. I mean, it's clearly said that we have shareholders that own shares of the corporation, and the shareholders elect the directors who appoint the officers to run the day-to-day operations. So it's a lot clearer sort of what everybody's roles are. It's also maybe easier to raise capital in a corporation than a partnership or a sole proprietorship by issuing shares. It's something that it's an ownership interest that's easily done. To create a corporation, you're probably all familiar with this. You file articles of incorporation with the government offices. So unlike a sole proprietorship that is very simple to organize and start up, corporation requires some legal work at the beginning. You have to file documents. You have to prepare resolutions of shareholders and directors, and you may be all familiar with what a minute book is, which is like a duotang binder or a binder that holds all of the important documents for incorporating and organizing a corporation. So generally you need a lawyer involved to sort of organize that and get it all started and maintain the corporate records to make sure you keep proper records of share issuances and appointments of officers and so forth.
And when you create that, when you first build that book and you file these things called articles of incorporation, which is what gives birth to your corporation, either under a provincial statute or under a federal statute, it's in that original creation that you determine, at least initially, what you want your capital structure to be comprised of. So for a simple company, you might just want to have common shares. If Nancy and I want to have our business owned by a corporation, we'll have just common shares, and we'll own probably an equal number of common shares. You can then, as time goes on, you can create different types of shares that have different rights and privileges and obligations. And that typically happens when companies grow and you're going beyond your sort of friends and family financial supporters, and you're going out to arm's length parties, particularly angel investors and venture capital firms, who will have very specific demands as to what they want. And what they will typically want is they will want priority over the founder. They'll say, okay, before you guys take any money out of the business, we want to see a certain prescribed return. If the business doesn't go well, we end up having to sell all of his assets and dissolve the company. We want to get our money back before you guys participate in anything that's left. So, and all that can be completely customized, and you can create shares, you can amend the nature or features of shares anytime by filing articles of amendment. Now, the only thing is, as you get more shareholders into your company, you need a resolution. You need to get not an absolute consensus, not 100% consensus, but to file articles of amendment. Is it 66? Yeah, 66 and 2/3 of the shareholders of that class is going to be affected. So you have to get it. You have to get 2/3 of the folks on side to affect the changes that you want. So change can happen, but the more people you bring into your business and the more divergent their interests and goals and objectives are, the more difficult it is to manage. But these are common growing pains, but it's important that you know about them as you're going into this arrangement.
Yeah, I guess one of the important advantages of using a corporation also is the limited liability that shareholders have. Basically, if you're opening your sole proprietorship and you're worried about losing your house, if you're that worried about the liability issues, then incorporate. Incorporate, you become a shareholder of the corporation, and as a shareholder, you're limited to the amount of money you put in to buy those shares initially. You're just your share capital investment. So you can sleep at night knowing that if the corporation goes under, you're not going to lose your house.
You're only going to lose the money that you've committed to the company already by buying shares, or that you've made a commitment to fund them. Same with a limited partnership. The nice thing about a limited partnership is that as a limited partner, the most you can lose is what you put in or promised to put in. And with a corporation, it's just what you put in, so whatever shares you buy. That does give some cover. The only exception, we'll get to this in a minute, is boards of directors can have some exposure in addition to what they might have as an owner, because there are some super liabilities that go beyond the corporation up to the members of the board.
And another advantage of using a corporation is that the existence does not terminate with the death of the shareholders. The corporation just keeps continuing on, unlike the sole proprietorship.
Corporate governance, that's me. Anything else you want to say?
Yeah, no, I was just going to say, like, for corporations as well, we talked a little bit before about selling the assets of a sole proprietorship and how sort of complicated it is because you have to go through all the assets and different asset groups to sell the business. If you incorporate, and say the corporation is pretty large, you have a fleet of vehicles, you have computer equipment, you have all sorts of assets. If you decide to sell the business, you don't have to do it asset by asset. You can simply sell the shares of the corporation. So you can sell 100% of the shares that you own of the corporation to the purchaser, and the corporation is the one that owns all the assets, so you're not transferring ownership of any of the assets, you're simply transferring the shares of the corporation. So from a transaction point of view, it's a lot simpler and tidier than having to do an asset sale. But again, there's benefits for vendor and purchaser on asset share purchases that would come into consideration at the time as well.
Yeah. So let's just talk a little bit about corporate governance. I mean, you could talk about corporate governance for a whole evening, so we're just going to give you some high-level stuff. And I apologize if some of this is a bit rudimentary, because I'm just not familiar with the sophistication of everyone in the audience, but I just really quickly, so you understand, there's basically 3 levels in a corporation. There is the people that own it, and those are the shareholders. There are the people that run it day to day. Those are the officers of the company. And those officers are appointed by the board of directors, who have ultimate responsibility for the direction and management of the company. So they'll basically set the strategic objectives of the company and then mandate the officers to execute that plan. Now, in a small company, the directors, officers, and shareholders are often the same people. In fact, you'll often see one person who is both the president and the treasurer and the secretary, and that's all okay. And you want these different business cards for different purposes, and it's not sneaky, and it's not uncommon. And as the company becomes larger and more sophisticated, you bring more people in with unique skill sets. Then they more legitimately become the CFO and the secretary and so on. But that's their basic sense of responsibility. Shareholders really are generally passive. You only have to go to shareholders for very fundamental changes in the business. So the various corporate statutes. So every province has a corporate statute, and then there's a federal statute as well. And it depends where you incorporate, it depends which one you're subject to. And it articulates a number of actions that a corporation might take that require 2/3 of the shareholders to approve. And I can't remember them all, but it would include things like changing your share structure, changing the terms of an existing class of shares, changing the name, dissolving the company, sale of all the assets. So you get the basic gist of it. Any really big decisions go down to the shareholders. Now, that level of approval can be made even higher if you create, we're going to get to this in a few minutes, if you create, and we strongly recommend you do this, when you're a small private company and you're bringing people in to work with you or to help finance you, you enter into a unanimous shareholders agreement. And I underscore the word unanimous in that if you're going to have a shareholders agreement, it really isn't much value unless every shareholder enters into it. The reason is if you wish to sell your business or all of the assets, a shareholders agreement can make sure that it says, if 75% of us want to sell it, we can compel the other guys to come along. If you don't have that and 75% do, or if 60% want to sell it and the other 40% don't, you're stuck. You can be very paralyzed. So it can be very challenging. So having a unanimous shareholders agreement, we're going to get to shareholder agreements in a minute, is really important. And directors have very clear general responsibility for the management and direction of the business. Those responsibilities can be carved out and put down to the shareholders, but only, again, with a unanimous shareholders agreement. So you can essentially carve back responsibilities of the board, put them down to the shareholders, and that's not uncommon at all with a small business, with an early stage business. Fiduciary duties. Now, directors and anybody who hasn't been under a rock and read a newspaper in the last 10 years, you realize that the courts are looking more and more at boards of directors to ensure that they are fulfilling their fiduciary duties. Is that the 5 or the 10?
10.
That's the 10. Okay. Now, fiduciary duties are duties that are determined in the common law. So we're a common law jurisdiction, like England, like India, where the law is constantly evolving and it's determined by new cases are constantly determining the law. You have statutes as well, but it's not like in France or Quebec where it's a civil code and everything is essentially codified. Our law is very dynamic. The law around fiduciary duties and the duties of directors to their shareholders and actually to a broader class called their stakeholders is very much a growing area of law. And it's important as you go into a company and become a director, you know what those responsibilities are. So the basic ones are you have to act, and this wouldn't seem like a big surprise, but based on the performance of some people, it does seem to be a surprise. You have to act honestly and in good faith with a view to the best interest of the corporation at all times. So, for example, you could not be a director of an officer of a company that's directly competitive to your business. You couldn't drive business if you owned another business that was maybe competitive, you couldn't drive it to another business. You couldn't say, well, that looks like a really interesting transaction. I might just do that one on my own and not give it to the company. That's called a misappropriation of a corporate opportunity, and that's a tort in law, and you can get your butt sued off for that. So this very high level duty is very important. Then it gets down to, and this is the top one is more of a subjective test. The next test is a bit more objective in the eyes of the court, and that is you have to exercise care, diligence, and skill that a reasonably prudent person would exercise in comparable circumstances. So who is the prudent, reasonable person? The court has to decide that every time. But they will basically try to decide if in fact your behavior did measure up against that. Before we go on to shareholder agreements, I just want to remind those of you who are directors of companies that you understand there's a couple of super liabilities, and I won't get them all right, and I'm not a tax practitioner, so I might be missing a few. But there are certain liabilities that a corporation has, and those, for example, employee remittances. So companies are required to withhold certain amounts of government remittances from their employees' pay and then remit them up to the government, like CPP contributions and vacation pay. If you withhold that and don't remit it, or if you keep back vacation pay and don't pay it to the employees ultimately, and the company dissolves, the directors are responsible for those. So that can be a really big number if you had a fairly large business. And there are, for example, you have to remit GST, PST, all these different taxes. If those don't get done and done well, the directors can hang for those. So a lot of people think, oh, you know, I got all the protection of a corporation, this is great. Not so great. Like, you really have to pay attention, and you have to be very careful before you go onto a board of directors. You have to have great confidence in the men and women below you that are actually running the business and that have the responsibility for the collection and remittances of those obligations. And you should have checks and balances so that when you have your monthly board meeting or quarterly board meeting, that your controller or your CFO comes to you and gives you an update that all those are, here's what our obligations are, we've collected them, we've remitted them, and here's a receipt. I mean, you don't go out of that meeting until you get that comfort. It's really, really critical because you're personally exposed. And I have been on the wrong end of that, and it's very unpleasant. But better to learn these lessons early. So let's just go on to shareholders agreements, because these are the Bible in which the relationship between shareholders and the company are memorialized. And a lot of the things we're going to talk about in here are, many of them, not all, are often common to partnership agreements as well. So a lot of the ideas that you'll see in shareholders agreements, if you are looking at starting your business, if you've started a business and you're in a partnership and you don't have a partnership agreement, some of these concepts you should be giving serious consideration to and possibly adopting. Okay, so we're on the same page here. So basically what it does is it provides the rules of engagement between owners and between the owners and the company, and between the owners and its board of directors. So board of directors have these certain very high level responsibilities, and as I said before, you can use a shareholder agreement to say, you know what, we don't want that responsibility left up top. It's so important to us, and it's so important to us that we know what's going on. And unlike a limited partnership, it's okay to be involved and to be engaged. It doesn't impact your liability. So with early stage companies where you really care about it, a lot of this you might require that the board, certain decisions that would usually be made by the board only be made by the shareholders. Typically there will be rules as to how your shares can be, one, how they can be sold and transferred, and two, how they can be encumbered. So if I buy shares in RIM, I'm quite welcome to go and pledge those shares to a bank as security for a loan. RIM doesn't really care about that. They're really fungible assets. In a private company, I'm not sure that the rest of the shareholders would want me pledging them to, say, an institution, or worse, to a friend they don't know who's going to lend me some money. Because if I default on my loan, that person who lends me the money takes my shares, which were the security I pledged to him. He's the new owner. So now you're in bed with this guy who you never knew before. And a lot of, particularly small companies, for example, they also have rules that not only can you not pledge them without the consent of the board or the other shareholders, but you also have put rules in there that if I die, they don't necessarily want my wife to be their fellow shareholder. So there will be a rule that if I die, they either, the company can buy them back at fair market value so that my estate isn't prejudiced, and often they'll have life insurance policies put in place so that if a key shareholder does die, there is money, there are proceeds from that insurance policy to buy my estate out. But it just protects them from, and this is really important in small corporations and professional corporations, we only have a few partners, where really the owners of the business, the men and women that are operating the business, the 3 or 4 of them are together because there are unique skills and qualities that they bring to the table. My wife may not bring the same qualities and skills to the table that I do. So they don't necessarily want her as a partner. They'd rather buy me out and then go and find someone to replace me. So you'll often see very clear restrictions on the transfer and rules around sale and rules around encumbering shares. Preemptive rights, very common thing to have. Preemptive rights, I'm sorry, just babbling on here, not following along. So preemptive rights are essentially a mechanism where, let's say a bunch of us own a company together, and then we go out, we say, okay, we need to go and raise some more dough to grow the company, and we're going to do it not by borrowing money, but by selling more shares. I don't want to be diluted. I'm a 33% shareholder with Nancy and Suresh. I don't want to be diluted, so the deal is that, okay, Craig, if you don't want to be diluted, then you can, out of this offering we're going to do, you can buy the number of shares that will preserve that you still own. At the end of that offering, you still own a third. So it's basically just to preserve, it gives you the right to preserve the status quo as long as you've got the financial resources to step up and take advantage of that right. A right of first refusal, colloquially referred to as a ROFR, very common thing. Again, 3 of us own a company. Nancy says, you know, I don't want to be in business with you guys anymore. I've got a new opportunity. I'd like to sell my shares. If there's no restriction in there, we might at least want to say, okay, Nance, you have to first offer them to me and Suresh at the same price you could get to a third party. So if an arm's length party comes to Nancy and says, you know, I really think this is a great company, I'd like to buy your shares, Nancy has to first offer that up to Suresh and I, pro rata, on terms no less favorable than what she was offered. That's really common and really ensures fairness. Drag-along rights, if Nancy gets an offer, drag-along rights basically are there to say, if Nancy gets an offer to buy our company, I want to say, wow, that's a fantastic valuation you're getting on your shares. I want that lift too. Nancy, the only way you can sell those shares is if the buyer agrees to buy mine and Suresh's on exactly the same terms. So it's all or nothing. And that's often really good because for a couple of reasons. One, you don't want suddenly to have a new shareholder in there with a different agenda than what you've got, and also you don't want to be left behind in that wealth creation moment. There are also things, drag-alongs, piggybacks. So that's piggybacks and drag-alongs are that if they come to me and they say, Nance, really want to buy the company, Nancy's going absolutely great, Suresh is absolutely great, and I kind of go, no, I don't think we should sell yet. I think there's way more value to be built in this company. I think it's premature to sell. I can frustrate their effort to sell the business. Unless there's a drag-along right that says if 2/3 of the holders of 2/3 of the business want to sell, they can compel me to sell my shares on those terms. And that's a really great thing to have, because particularly if you have lots of shareholders and you wouldn't want one person who's for some reason got an axe to grind and really is just being more malicious than anything else, is frustrating that sale. And that could happen because that 10% holder is wealthy and doesn't need to sell and just wants to make Suresh's life miserable. He could do that. But if you have that drag-along right, you can completely ignore that really, really unbearable situation. And we've seen it happen all the time. And I think this brings us to a really good point that Nancy alluded to at the beginning. Whether you're going into a partnership or you're entering into a corporate relationship with a bunch of other shareholders, it's really important not to think that don't look through the world with rose-colored glasses. Cover them in mud and think how miserable. Like, what if Nancy becomes really miserable? What if Nancy runs into a really difficult financial crisis and she needs to act differently? You really want to ensure that you think of all the contingencies, put them all in the agreement up front, so that when you run into difficult situations, and life is full of them, and they're inevitable, that you've got a roadmap for how to get through it. Because without it, getting around the table, everybody's got a different agenda, everybody's got different interests, everybody's in a different level of crisis, everybody's got different economic resources. And this brings us to one more common feature that many of you have probably heard of something called a shotgun. So a shotgun is very common when you have a small number of shareholders, and you get in there and say, okay, what if Nancy and I own this business together, and it's going great, we're building value, but I want to take it this way, and Nancy wants to take it that way. Well, it can end up being paralyzed. You can end up compromising the value of the business. You can miss all kinds of great opportunities. With a shotgun, it's a mechanism that basically says, okay, we got to break this impasse. So I say to Nancy, okay, Nancy, here's the deal, Nance. I'll buy your shares for this much, and if you won't sell them to me for that, you have to buy mine for that much. It's not, you can, you must. So I pull the gun, somebody's going to end up owning the business. I mean, it's a scary thing because it's absolutely irretrievable, but it does break the impasse. What it does ensure is that, except in one circumstance, which we'll get to in a minute, it ensures that I'm not going to be unfair when I offer, as far as value goes, when I go to ask Nancy to buy her shares, because if she does not accept my offer, she's going to buy my shares for that price. So I'm not going to go on a low ball. The only way that this becomes unfair is if Nancy has lots of money and I don't. When there's a real disparity in financial resources and Nancy's got lots of money and she comes to me and makes the offer, she could pick kind of something well below what it's really worth. But she knows I don't have 2 nickels to grind. I'm leveraged up to my yin yang, and I just don't have any more credit. I can't buy her out at even a modest number. So she'll offer me something very low. I can't buy it, and she steals the business. So shotguns are dangerous if you're going to business with someone who is fairly even. Then I strongly recommend a shotgun, and that you have a very fulsome and open discussion about them and about the consequences of their use with your partner at the outset. I'll start. There's no rules really. So typically you start off and you have 2 or 3 people going to own a business, and you might all own it equally. And that might be, some people may put in cash, some people may put in intellectual property or other assets, and that's fine. You just have to agree as to the value of those non-cash assets that are being contributed to make sure everybody agrees that's their value. And then you distribute the shares based on that contribution. You might start a business with virtually no capital in it yet, and everybody just puts in a nominal amount and you take an equal number of shares. As time goes on, as you use your share capital to raise money and you're selling shares, you say the enterprise is worth this and we're going to sell some shares to represent that value. Or if you want to incent employees by giving them ownership, we typically would say create a plan so you know what the rules are so that it's not done on a really ad hoc basis. You often see people giving options willy-nilly around because they want to keep people happy or incent people. And then you end up with something that really doesn't make sense down the road and isn't necessarily fair. So often you'll see, this is very common in public companies, but not uncommon in private companies, and I encourage it, if you want to use equity to incent parties, first of all, you have to have some mechanism for valuing your company when you do it. Now, valuations by a third party are typically very expensive, and small businesses don't like to do it. So sometimes you might want to create a relatively simple formula, and that might be based on revenue, it might be based on net income, it might be based on a lot of different things, and accountants and tax guys will sit down and sort of help you devise that mechanism. But having a very clear method for determining value is key. And some companies, as they become more mature and have more financial resources, will say, okay, annually, for the purposes of doing our employee option grants, we're going to get a valuation done. And you have an arm's length evaluator that knows your company well. So incrementally each year, he knows what it was last year. He's got a baseline, and it becomes more economic as time goes on. That's not a bad idea at all. But to have a plan so there's only a certain amount of equity that's going to be available for options. What you might find though is that you say, you know what, we need to get this guy from the industry to come in and become head of operations. And how are we going to send him? Well, that might be something that's going to be outside of the plan. And if you do that, then you might do it straight with stock and just say, and you might have to go to shareholders to do that. that we've got to give this guy 15% of the company just to get him in the door because he's leaving something really valuable. So I guess the bottom line is there really is no rule of thumb, but it's something that you should probably speak to council, and as time is going on, your needs and what you want to do with your share capital and how you want to use it as a tool and as a retention tool and as a recruiting tool, as that evolves and becomes more meaningful, there are different things you're going to want to do. I mean, do you want to add some detail to that?
Yeah, no, I was just gonna say, like, when you're first incorporating a company, a lot of companies just start with like common shares, so one class of shares. It keeps things very simple, but if you want to start having different classes of shares and create a class of preferred shares or something like that, you can really get as creative as you want with the preferred shares. Generally, the common shares would be, they're entitled to vote, to dividends, and to participation in the dissolution of the company. But you could have preferred shares that are non-voting. For example, you want to give those to employees or non-voting, and you could declare different dividends on those shares. Or they could be redeemable, so if they could be voting and redeemable, so if the company, you decide you've been issuing too many shares with voting rights, these preferred shares, you could redeem some of the shares, you could force them to sell them back to the company. So and like Craig was saying, you generally need to look and see where the company is headed, like where are you thinking, what's your 5-10 year plan, whether you think you're just going to sell it to another private company or if you think you're going to take it public. Because you want to think ahead of time to sort of set up your capital as the founders, generally we see in a lot of companies that are intending to go public, the founders will issue themselves a large number of shares for a nominal amount, just to make sure that as they do their successive financings, they don't get diluted down too much. But there's also an issue where if that company goes public, the stock exchanges will look at the initial founder shares, and if they were issued like too cheaply, like 0.0000 of a cent, and too many of them, they may require the company or the shareholders to cancel some of those shares, or so, like they have sort of limits that they watch those. But yeah, I think you definitely just need to sort of try to see where you're going to be and plan backwards and see like what uses you want for shares, whether it's employees or consultants or other people.
Yeah, and I think you'll find when we get into some of the value drivers after dinner. One of the big things you'll find with venture capital firms and private equity firms and even sophisticated angel investors, which is probably where most of you are going to be going long before you go to the public markets, is that when they open up the book to start looking at your business and they see a really complicated share structure with a bunch of different classes of preps and a bunch of options and a bunch of warrants, first of all, they look at it on a fully diluted basis. They want to know, like, how many shares could really be out there, and what does this mean to me? They're also going to say, you know what, I don't care what those prep shares are, we're going to get in front of everybody. So either we create a new share and the shareholders are all going to have to vote to approve this. So, like, my recommendation is, like, keep it simple, stupid. Like, keep your share structure as uncomplicated as you can. Ideally with just common shares, because when you get that first sophisticated investor in there, they're going to be looking for preferred shares that give them a preferred return, a hurdle rate before you get anything else, and they're going to be looking for a priority on dissolution or end sale. So if the thing gets sold, they're going to want to see they get paid first, they get a certain prescribed return before the commons get anything. So you just have to just face that reality, and what you don't want to do is have it highly complicated, because if it's really complicated, it forces the buyer or the investor to negotiate with a bunch of different stakeholders with different interests, and that can be, and then they have to, well, they just go forget it. This is too complicated, it's a pain in the ass, doing all these people, forget. And I would also say, if you're bringing in a bunch of shareholders, and we'll get to this after dinner as well, often you just have to keep going and finding more folks to put money into your company. Sophisticated investors don't want to have to deal with everybody. They would often like to see a voting trust where, the majority shareholder, the founder, has the ability to vote the shares of all the mom and pa, who everybody's put in $1,000, right? Because you don't want to have to deal with each one of them and get their votes. So I just want to know I can talk to you, and you've got 75% of the votes in your pocket by way of a proxy or a voting trust, and I know that if I deal with you, I can get the deal done. That's really important. So bottom line, I say the first answer is keep it as simple as you can.
Quickly, I have another question.
I just want to add to the question and give some scenario based on a startup, and I would like to get your reaction to whether this is reasonable or unreasonable, or how company, the two founders, they've been working on that company for 6 months to a year. They contributed the technology. So on day one, they issue 50% each to them. Then they go to an angel, raise about $150,000, and so angel gets 15% of the total. So they get diluted accordingly. Then they want a industry expert to act as an advisor. So they're looking for 2 or 3 industry experts, and they reserve 5% of the shares to be issued to these industry experts over a period of time, not necessarily on day one.
After they deliver value.
After, yeah, maybe the shares will not vest right away, but they will be issued or promised or something like that. And then they want to bring in 2-3 senior people who will work full time in the company as the company is growing, and they want to reserve about 10% of the total capital to be distributed to top 3 or 4 employees of the company, which will be given to them on delivery of certain milestones. Does that structure look reasonable, or it's unreasonable, or it's kind of too much, too rich for the employees? Or
My sense is it sounds reasonable. I mean, again, it's all really how much value you attribute to those various third-party advisors. Now, one little thing though is shares can only be validly issued if they're fully paid for. So you can't issue shares on the hope that they're going to provide some great services. They can be issued as, you can reserve them, but they can't actually be issued until those services are actually provided, and the directors basically have to state in the resolution authorizing their issuance that yes, that is the value the value of those shares is equal to the value of those services provided. So they have to, so that they can, and this is very important because when you ultimately go public, if you do, your underwriter or agent is going to go back and look at all the historic share issuances and want to make sure that they've all been validly issued. And those are the sort of things that can become a problem if shares were issued for no consideration because they aren't validly out there. So it's just, again, as we're going to, a theme and we're going to talk about after dinner is developing really good discipline practices around this stuff from the very beginning is critical because it can be fixed. Having a complicated share structure can be fixed, but it often ends up with people being disappointed, lots of legal and accounting fees being incurred. Yes, but that's a pain for most people. So it's just being very disciplined from the outset. What you described does not sound unreasonable, assuming that the value that those industry providers are going to provide is material and it's going to be really helpful and so on. And the allocation for key employees also sounds quite reasonable. The only thing is I would just make sure that you keep them all in one class.
Okay.
Yes, sir. Yeah. Yes.
Another follow on various shareholder rights. How common is tag-along rights which protects minority shareholders?
Very. Yeah. Very. Good. And I think that's just it's really fair because often the small shareholder is the early shareholder who, without them, it never would have got going, but then the big guy comes in. You don't want, those poor guy doesn't want to be left behind, and it's not fair. So I think often a right-minded founder will want to protect those early shareholders, and if the big guy is able to attract a takeout, that they get to go out along as well. So it's very good. Time for dinner? Oh, one more question?
One quick question. When would I want to form an Ontario corporation versus a federal corporation? Why would I want to make a federal corporation or an Ontario corporation?
Oh, federal or Ontario? Is that the question?
Yeah.
Yeah, the CBCA and the OBCA, the two acts are fairly similar. If you plan on just doing business in Ontario, like I think the OBCA is probably fine. It's the federal company you might use if you plan on doing business all across Canada, but really I think the differences between the act I think are
hardly anything.
Yeah,
well, a couple of tricky things are if you want to get a name registered under the CBCA, it's considerably more challenging. If you haven't even, like in Ontario, as long as your name isn't identical, but it's similar, you can get it. It's just you're at risk that someone with a similar name might say you're passing off. But that's your problem, is the Ontario Ministry's view. Federally, if you're too close, they won't let you have it. So often people default to a provincial incorporation just because they can't get the name they want federally. And then if they wish to carry on business in other provinces, they have to be extra provincially registered, which isn't a huge amount of money, was it $500 or something? But it's just, then you have to make sure you keep it up every year, and it's just another thing to manage. And then the question is, what does it mean? What am I doing if I'm carrying on business? Like, what does it take to be carrying on business? If I'm just selling widgets into BC, am I carrying on business there? You have to kind of figure out those questions. So I see most of my clients set up OBCA companies. They're cheaper, they're faster, and they're a little cheaper to maintain. And as the company grows and they become more active, they have to provincially register in other provinces where they're active. And it's really, I don't think selling into another province is the problem. If you've got salespeople on the ground in BC, you probably do. And then you have to register. But if you're just selling there, it's probably fine. So I think you'll find most startups are just doing provincial registration.
Absolutely, the last question before dinner.
Okay.
It's a quick question. When you're starting up and forming a corporation, one of the questions that comes up is how many shares you want to have in the organization. Now, if you're starting up, you have no idea absolutely how many. So is there a rule of thumb, like?
Usually we do unlimited, we do like an unlimited number, like generally like we do an unlimited number of common shares.
What do you mean, talking about authorized capital or the number that you issue to the founder?
Issue the founder.
Oh,
that's
issue the
right.
founder?
I
Oh,
mean,
sorry.
you are the only one, so.
Oh, how much should you
but
issue to
even
yourself?
if it is unlimited,
Okay.
Right.
it's yours.
Right, so I think what Nance was saying, I mean, you have to authorize how much capital your company has to issue, and that we typically make that unlimited. I usually pick a big round number, not 1 million, but I often pick like maybe 10,000 shares if they contemplate bringing other shareholders, just so it's easy to slice and dice it into even numbers. I mean, you can always do share splits and create more shares, and lots of ways to deal with it, but I usually start with like 10,000 shares. And then it's just easier to do the math without being too terribly diluted. And it depends whether you're going to give shares to new shareholders by issuing them out of treasury or just selling my shares to them, because you can do both.
Thank you, Craig and Nancy. I'm sorry I showed you the card so early, didn't know I was even ready. But let's break for dinner and we take 25 minutes for dinner.
Terrific, great, thank you.